morning, ladies and gentlemen, and welcome to the webinar from MBG Corporate Services, Achieving Resilience Through Restructuring, the second chapter in this sequence of webinars. Today's agenda, I will give a very brief overview of MBG Corporate Services, and I will wrap up with a Q&A session at the end. And we have the return of our speakers, Mr. Alok. We have two new speakers for this webinar, Mr. Naresh and Mr. Vipin, who will go through their sections accordingly. So, ladies and gentlemen, for those of you who aren't familiar with MBG Corporate Services, I'll give a very brief overview. We're established in 2002. We're headquartered in Singapore. We have 16 offices across 6 locations. Here in the UAE, we have offices in Sharjah, Abu Dhabi, and Dubai. And from our offices in key strategic countries, we operate in Europe, Middle East, and Asia, servicing those communities. We have over 3,000 clients globally, and we're very proud to work with over 100 Fortune 500 companies. Across our organization, we have over 450 employees. As a firm, we have a huge range of services, which my colleagues will touch upon, I'm sure, in the subsequent presentations. A brief overview here of the audit and assurance, taxation and risk advisory departments and all the services offered, followed by mergers and acquisition, legal advisory, strategy and transformation, and technology advisory. Given the current situation in the market, we've also been responsive to market needs and set up services orientated around COVID-19 and the impact that is having on business immediately and as a result of this pandemic. As a firm, we are affiliated with, in the UAE, we're affiliated with all the main players which you'd expect. From a government point of view, we work very closely with ADNOC, Department of Economic Development, ALDAR, and Dubai Ports for the Unified ICV program. As an authorised tax agent, we work very closely with the Federal Tax Authority and support many of the main free zones with strategic engagements on that side. From a bank empanelment point of view, we're empaneled with all the main banks, which you'd expect from a firm of our nature. Partner network, a wide-ranging partner network from technology to legal to local accounting services. And with the chambers and trade bodies, we work very closely with all the main chambers and trade bodies in this region, taking feedback from their members, but also providing seminars and webinars to them so that we can impart our knowledge on the business in the UAE. So, ladies and gentlemen, I'd like to introduce our first speaker. Alok Bishnoi is a partner based out of the UAE with over 20 years experience in risk and business advisory, enterprise risk management, corporate governance, business process re-engineering, and finance and accounts. He's extensively worked for sectors such as healthcare, education, oil and gas, manufacturing, utilities, investment, transportation, infrastructure, financial services, etc. And worked out of UAE, India, Qatar, Saudi, US, Singapore, Europe and Africa. So a very holistic overview that Alok has. Alok, I'll hand over to you.
Thanks, Oliver, for the introduction and corporate overview of MBG. Good morning, all. Thanks for attending today's session. COVID-19 pandemic is old news now. What's next? That's the question everyone is asking now. The future is not what we thought it would be only a few short months ago. In the previous webinar in this series, we discussed a few aspects related to strategic transformation and restructuring, which will help organizations survive and thrive in the current scenario. In today's session, we'll discuss a few broad ideas that we thought would help business get ready for the new normal. The key ones being cost optimization and financial restructuring. In each case, we will discuss which attitudes or practices businesses should stop, which they should change, and finally, which they should accelerate. Next slide. Next slide. Yeah. Nowadays, responsibility takes a whole new meaning as organizations try to balance the welfare of their people with keeping their businesses afloat. Overwhelmingly, we are seeing leaders putting their people first and exhausting all other cost-saving options in order to retain their talent while staying solvent. A crisis like this is temporary, and those organizations that put people first now will keep their support in the future, as well as be prepared for the rebound when it happens. But this means taking a creative and agile approach to managing the costs. 5 questions which are keeping the C-suite busy currently are: which cost should I cut? We are making hard decisions every day in cost cutting. How do we ensure that the team is taking the right decisions? Most of the operations are closed, but we are still bearing all the major costs. How long can we sustain like this? Are layoffs the only solution? How do we balance our needs to reduce expenses with our desire to innovate and create new revenue streams? There are multiple answers to all these questions. However, the theme is one: an effective cost optimization framework. Cost optimization is definitely better than cost reduction, as it is closely linked with analyzing the core strengths of the business and the management team and coming out with feasible and long-term solutions. At MBG, we have helped our clients by implementing the following 3 steps. In first step, which is analyze, we understand the organizational strategy, goals, and objectives. This is followed by performing a high-level cost due diligence across all processes and peers to set a cost optimization target in consultation with the senior management. The senior management buy-in is very important in this case. The target is tailored to the organization, and hence it is more acceptable to everyone. In step 2, which is optimize, we follow a structured and systematic approach to identify key areas for improvement and potential quick wins. We develop a profitability tree and map the key cost drivers and identify the important areas. No one size fits all, as they say. Hence, we need to develop specific cost optimization targets for each department based on their contribution in the value chain. We assess the redundancies and recommend to eliminate them through a systematic plan. This is achieved through a series of steps, including, but not limited to, controls optimization, in-house versus outsourced decisions, centralized versus decentralized operations, etc. We also need to focus on efficiencies, renegotiating contracts, volume discounts, inventory optimization, better cash management to reduce financing costs, manpower rationalization, robotic process automation, digitization, etc. These are just few examples which we can focus upon. In our last step, which is transform, we monitor the cost optimization initiatives and targets set during the previous 2 phases. Each and every step needs to be tracked and monitored to ensure that the savings are captured and these savings are not spent elsewhere. Finally, the organization needs to develop a cost performance culture. It should involve everyone in the organization, specifically the operational teams who have key insight on where and how to optimize the cost. Next slide. A business process reengineering or improvement project involves a radical redesign of core business processes to achieve dramatic improvements in productivity, cycle times, and quality. In a BPR or BPI exercise, companies start with a blank sheet of paper and rethink existing processes to deliver more value to the customer. They typically adopt a new value system that places increased emphasis on the customer needs. Companies reduce organizational layers and eliminate unproductive activities in the two key areas. First, they redesign functional organizations into cross-functional teams. And secondly, they use technology to improve data dissemination and decision-making. A BPI exercise can be seen as an analysis, review, and improvement of existing processes. This is done by mapping out the business processes, identifying inefficiencies, redesigning the process, and benchmarking to initial metrics. Typically, the main goal of a BPI process is either one or all three of the following. Goal one is reducing process time, then improving output quality of the product or the service, and finally, cutting out redundancies if there are any. A normal BPI project involves 5 phases, namely assess, analyze, redesign, monitor, and optimize, which you see on your screens now. In first 2 phases, we understand the business model, objectives, and strategy of the organization. All the keys and support processes are mapped and their contribution to the whole value chain of the business is identified. Quantification of process times, quality of the product, and controls, mapping, and redundancies is performed. The next phase is to rethink the existing process to deliver more value to all the stakeholders, namely shareholders, the customer, employees, vendors, and also to the community at large. All modifications suggested have to be closely monitored to ensure that the desired results are achieved. This is done in the 4th step, which is monitor. The final step is to understand and take feedback if there is any operational improvement suggested and achieve complete optimization of the process. Next slide. We come to the next section of our presentation, which is financial restructuring. I know in the current scenario, getting more cash is on everyone's mind. Working capital or working capital optimization. What do those words really mean for us? And why is it necessary to do a working capital optimization? If we think about majority of global corporations and the need to function profitably, then the conversation about optimizing working capital goes far beyond the CEO's office. Rather, it's a dialogue that happens daily between the CFO and the finance team. Working capital is an interplay of the above highlighted 5 sub-processes. The inefficiencies can be hidden in either one or more of these sub-processes and may hamper the smooth flow of business in the normal business environment also. During a pandemic, there is direct and indirect impact on any or all of the processes in an organization. Hence, it is all the more important to closely review and monitor these and ensure that cash trapped in the working capital is quickly released and used for sustaining the business. Inventory cycle of almost all the organizations has been hit during COVID-19 pandemic. Supply chains have been broken down, leading to situations of understocking or overstocking. Organizations need to rework on the demand forecast in wake of lockdowns and limited openings. This needs to be updated in the revised production plan to ensure timely availability of raw material and finished goods. All the inventory level needs to be recalculated in the current circumstances. This would definitely lead to freeing up of the much needed cash. Accounts payable is usually seen as a back office function. It doesn't always take the center stage as businesses look to grow or build competitive advantage. In fact, often account payable takes a backseat to management's competing priorities. When it comes to working capital optimization, however, increasing payables should be the core strategy. To be sure, many businesses work this strategy by extending payables as long as possible to maximize the free cash flow. Unfortunately, this approach is not always the right one. In some cases, delaying payment can erode supplier goodwill, resulting in slower delivery times, less willingness to fix defects, slow responses to queries, and a more onerous payment term. On the flip side, paying early can sometimes yield substantial benefits in situations where suppliers offer discounts or rebates for early payment. To effectively identify these opportunities and determine the right course of action when facing a potentially conflicting outcome, businesses must take more strategic approach to the accounts payable. The accounts payable team, along with the purchasing or procurement department, must collaborate with senior management to inject a working capital culture throughout the organization. This is about more than ensuring invoices are received and processed in a timely fashion. It's about adopting management focus that emphasizes the importance of optimizing payables and freeing up the working capital to fuel growth. Most businesses have formal accounts receivable policies that dictate when to bill, how much to bill, and when to collect. Unfortunately, not all businesses enforce these processes or policies effectively, or even adopt right processes at all in some cases. In many cases, it comes down to culture. Businesses that prioritize sales often fall trap to extending credits to customers, offering discounts and ignoring payment terms if it means winning new sales. However, if management does not have a focus on working capital, no one will. The upshot, you end up unintentionally providing customers with free financing. Some may argue this is not a big deal, but the truth is not so simple. If a company needs to borrow money to meet its obligations because customers are paying late, it could incur losses on the financing charges alone. In my 20 years of career, I see this happening day in and day out with companies which are being run by professional executives who have decades of experience. Even if that's not the case, carrying overdue accounts receivable still has a cost. It puts you on a tight cash flow rope. Rather than having a free capital to invest in growth opportunities, increasing shareholder payouts, buying new equipment to introduce new products, your money is tied up in your balance sheet. We should look for options in supply chain financing. It can ease the pressures on the cash flows. However, the companies will need to perform a comprehensive analysis to ensure that they select the best plan available in the market, which is suitable for their business model. Effective management is the key. Otherwise, the penal charges or the interest may inflate the financing cost, resulting in eventual losses. As we say, accounts receivable, accounts payable, inventory, all these are components of working capital that companies can streamline to access cash trapped in their balance sheet. When approached holistically, however, proper management of all these sub-processes fall under the umbrella of effective cash management. To improve any of these levels, companies must create cash management culture. For senior management, this means going beyond and prioritizing cash flows in an effort to free up cash. It means encouraging financial and cash flow discipline in both good and more difficult economic times, which we are currently facing. Depending on company's goal, financial discipline can translate into different initiatives. This may include adopting of more prudent investing criteria or leaner cost structures, which we have discussed earlier. Either way, a focus on financial discipline, including integrated financial and cash flow forecasting, generally allows companies to strengthen their balance sheet, improve financial stability, and can lead to greater profitability. As a result, the company gains control and flexibility it needs to achieve a competitive edge during the current scenario. Next slide. Most shareholders and board members, management teams also, only experience financial distress like this once in their career. The situation can be confusing as a stakeholder. Priorities change when confronted with triggers of covenant breaches, maturity deadlines, or liquidity crunches. There is, however, an optimal way to navigate the situation and give the company the best chance of survival with a restructured balance sheet. Corporate financial restructuring involves restructuring of the assets and liabilities of the corporations, including their debt to equity structures, in line with their cash flow needs to promote efficiency, support growth, and maximize the value to shareholders, creditors, and other stakeholders. There are several reasons, financial and non-financial, that may trigger the need of financial restructuring, such as a company is in financial difficulty when it cannot pay its debt, financial or commercial, or breaches the covenants which are attached to it. In such distressed situations, the stakeholders, whether it's debtors or the lenders, want to protect their position and provide a stable platform to the organization. Few questions which are in mind of the senior management are, do I have enough funding to keep operating while a solution is being developed and implemented? What sustainable capital debt structures are there which have best prospects for success? How do I reconcile all stakeholder positions to implement a new debt capital structure? What is the role of alternative capital or debt providers in the solution? The answer to the above question lies in review of capital and debt structures of the organization. The debt restructuring is a process used by companies facing cash flow issues or financial distress to avoid the risk of default. It can be carried out by reducing the interest rates on loan or by extending the payment term. It can also include a debt for equity swap, which means that companies' creditors may agree to cancel some or all of their debt in exchange of equity in the company. Restructuring debt can be a win-win for both entities, as the company avoids bankruptcy and the lenders typically receive more than what they would through a bankruptcy proceeding. Companies can achieve debt restructuring by entering into direct negotiations with the creditors to reorganize the terms of their debt payments. Debt restructuring is sometimes imposed upon a company by its creditors if it cannot make its scheduled debt payments. We at MBG have performed multiple debt restructuring exercises. We have recently helped several businesses in real estate, retail, and hospitality sectors to restructure their debts and also managed to get additional cash to help sustain businesses in the current pandemic scenario. This year only, we have performed restructuring of deals worth more than $1 billion UAE dirhams. The process involves reviewing your business model, financials, and your existing capital structure and your relationship with the financial institution. Covenants need to be looked closely to ensure improvements, if any possible. All terms are renegotiated with the latest business plan and projections. The restructured loan with all the terms is submitted to approval of all the stakeholders. Once approved, the compliance requirements are closely monitored to ensure that the credit ratings are improved for any future transactions. With that, we come to an end of our financial restructuring session. We see some questions coming in, which we'll take at the end of the session. Please feel free to get in touch with me for any discussions on topics related to business advisory and financial restructuring. My contact details are mentioned at the end of the session. I'll now hand it over to Oliver for the other sessions. Thanks for attending.
Thank you, Alok. Ladies and gentlemen, for our next speaker, I'd like to introduce Naresh Manchanda. Naresh is responsible for driving business in the Middle East operations for MBG Corporate Services, leading M&A, risk advisory and legal practice, along with Chinese, Japanese and European enterprise business development groups. Naresh has a deep experience in cross-border compliance, taxes, finance, techno-commercial matters, and providing leadership in sales and operations. He's worked extensively in Europe, Middle East, Africa, and Asia regions, and over the years has led multiple verticals, including power and water, oil and gas, pharmaceutical, healthcare, regional shared service organizations, and corporate headquarters. With that, I'll hand over to Naresh.
Good morning, everyone. Thank you, Oliver, for the intro. So in today's session, I'm going to touch a bit on current environment, organization and employee transformation, COVID-19 and beyond, the choices that each one of us have. Next page, please. So in terms of environment, in today's time, all the firms need to adapt to society's changing preference. So each of our stakeholders is essential. These are the words from the declaration signed last August, where 181 of top big companies sat together in a business roundtable. So who are the stakeholders? Stakeholders are now customers, employees, supplier, communities, and shareholders, versus what used to be a case for corporation, they used to only focus on shareholders. So today's time, all stakeholders are important. Next page, please. So the focus is on purpose, empowerment, experimentation, and transparency. Next page. So in terms of organization and critical resources, we all work for different kind of organization structure. It could be a flat, divisional, functional, or matrix. Depending on the size and complexity involved, we make the selection. If it is a startup, typically it's a flat organization. As a company, we do functional, and once a company becomes listed or MNC, we becomes a matrix organization. Still, what is the most critical resource? It's you and me, human resources. Irrespective of the size or type of organization, human resource is the most critical one. Next page. Jeff Bezos recently addressing to its employees in September 18, he said, one day Amazon will fail, but our job is to delay it as long as possible. And Bezos' comment has come at a time of unprecedented success at Amazon. So each one of us will go through the cycle. Sometime we'll be part of a startup, sometime growth story, sometime exploring new market, and sometime diversification. Next page. So let's spend some time on transformation. We're going to take you through a sort of a case study. So it's about a big bang transformation, which a telecommunication giant had tried doing it. So most of the time when organizations are successful, the sense of we know it all and we are too big to fail comes in. So in this case, a telecom company wanted to launch a new digital platform in 2017. Objective was to boost subscribers through better digital engagement. It was an overarching strategy. Entire customer engagement was set up for radical change for next 1.5 years. Company wanted to go with speed and radically make investment for changes. And after a lot of efforts, a lot of investment, digital platform was actually launched, but there was a very lukewarm response. It failed miserably. Over 2,000 jobs were lost in that particular year. That's a background of doing an overall transformation with a speed and without delinking. And we'll, in coming pages, we are going to talk about how we can do in a different approach. Next page, please. So another dimension that we all go through is whether to be or not to be. So in today's context is to have our own employees, that is in-source or outsource employees, or to automate it. So answer in current times is for another company called Best Buy. Best Buy is an American multinational company in electronics headquartered in Minnesota. And also close to our home, another example is Dubai Mall and Noon.com. Let's first talk about Best Buy. So in 2010, a price comparison app was launched by Amazon that allowed consumers to compare prices in physical stores and order it online at discounted prices. This practice was called showrooming, which has threatened the retail business quite a bit. And real estate, staff, and inventory became a liability for retail business. Almost $1.7 billion was lost by the Best Buy in a single quarter in 2012. Then the new CEO who joined, he envisioned a company that blended the human and digital in ways that will be hard for digital-only players to replicate. Imagining what kind of experiences it can give it to the customer, where it has not leveraged digital technologies to create the experience. So he reinvigorated customer experience. He matched the prices of Amazon and other e-commerce player. He worked on overhauling warehousing, software, and supply chain activity. He also created a system to order online and pick up from store. So 70% of US citizens were living within 15 miles of the Best Buy store. So approach was extremely successful and cost effective. And the disadvantage of a real estate was also turned into an advantage. So brands such as Apple, Microsoft, Samsung, they created stores within the store, essentially paying rent to feature their offerings where real life shoppers could discover them. So Best Buy is a neutral party to tech giant. Both Amazon and Google sells their goods there. Finally, Best Buy invested in home advisor capability. Salaried, high-trained consultant goes to home and provides services without selling anything. The goal was to build strong relationship with customer. Best Buy steadily transformed its digital footprint to support this strategy. It illustrates us to rethink on assumption, how to repurpose, engage with the partners, and how to leverage the assets. He also worked on another area, which was employee experiences. So he reinvigorated popular employee discount scheme, and also huge tons of amount was spent on retraining of employees. So the another aspect we want to highlight from Dubai is MR Dubai Mall as well as Noon.com. So recently there was an interview with Mr. Mohammed Alabar. So the question was, how do we continue with both these platforms or this in this current time? His answer was how do we stay relevant? So learning from all of us is we need to be providing value add constantly. An answer is the right balance between human resources and digital alignment. Next page. Now let's talk a little bit about employee cycle and influence. So I believe the outer circle is clear to everyone where we talk about what's the recruitment process, but it is the inside that really matters. So the impact from leadership, customers, colleagues, competitors, and external world is what is helping employees to grow, mature, and ultimately transform. Thank you. Next page, please. So we have put together a page which basically reflects how the top 100 companies of Fortune 500, which has survived for more than 100 years, what they actually do to sustain and grow their talent, how these companies which have become anti-fragile or survive for so many period of time. So they do all these measures that we are highlighting on screen, but there are two critical areas, which is how employee satisfaction is increased. So employee satisfaction is highly dependent on or a positive correlation with customer loyalty and also with higher productivity. So these two key areas are very essential, how we have a correlation of employee satisfaction with the clients and also how we develop their productivity. So through these various programs that you see on the screen, through trainings, through internal mobility, through coaching, they continue to nurture the talent. And wherever employees are not able to pick up with the speed, then those employees are given other opportunities or given the exit areas so that they can go and influence in other companies also. Next page. Another dimension we would like to highlight is how do we involve our stakeholders in any of the program. So recently you must have heard about ICB program. So even before ICB program, if you really see how a single transaction has a multiple implication. So for example, Abu Dhabi has launched ICB program. Our firm view is it has a very deep program with far-reaching impact. Hence, we highlight to our customer to involve all the key stakeholders in the program as early as possible. The program is not only going to challenge past assumption, but transform organization as well as employees, as they need to think beyond the silos and develop empathy on how a single transaction impact other departments. Hence, simplification and transformation will be part of routine, not a big bang program. Next page. So to summarize, in today's time, we all have three choices as listed on the screen, but we'll focus more on the right-hand side. So robust and resilient is when things are able to withstand without weakening. Anti-fragility is beyond resilience or robustness. So catastrophes are the real examples or models where anti-fragility can be proved. So Japan is a classic case where tsunami struck, but within a couple of quarters, Japanese companies were back on track. Similarly, there was a survey done in Korea by Bank of Korea in 2008. In about 40 countries, there are about 5,500 companies which are more than 200 years old. And of these, more than 100 years of companies with 100 years were having employees less than 300 years, than 300 people. So what we're trying to say is only paranoia, proactive, positive actions with boring discipline will increase the chances of taking us through. Every organization, institution, and individual should work on this path. Next page, please. So what are the next steps for each one of us? So irrespective of what position we hold in the organization, it is our utter responsibility to highlight any issues that we face in the organization, talk to the manager, talk to the right stakeholders. And if you need a support, MBG team can have an initial discussion for you. Next page, please. So MBG with its industry as well as consulting experience can help you and your organization in strategy, operational, process, and compliance arena. Thank you.
Thank you for your insights on that, Naresh. I'd like to introduce the next speaker from a taxation perspective, Vipin Ahuja. Vipin has over 13 years experience in advising clients on the entire gambit of indirect tax, regulatory issues. He's passionate about indirect tax with the ability to manage figures, legal knowledge, analytical skills, and has very capable project management skills. With that, I will hand over to you, Vipin.
Thanks, Oliver, and good morning to all of you. Today, I am going to talk about restructuring from taxation perspective and how companies can utilize the tax procedures for cash optimization. Firstly, let's understand the taxation cycle of a company. When an organization, even a highly successful one, experiences sudden financial downturn, it may need to consider such option as reworking on financial structure or maybe redefining policies and procedures, including taxation also. As there is always a time lag between collection of tax, payment of tax, and recovery of input tax credit, it impacts the cash flow of any entity. So, proper tax planning at various points can improve the cash flow of all the companies. We understand that all the organizations are seeking to continuously improve their internal indirect tax function and identify, realize, and protect cash enhancement opportunities. It is important to review cash optimization in 4 key areas. These areas can be cash recovery, cash flow improvement, process improvement, and risk management. In cash recovery, we can explore the availability of any historic VAT reclaim with ongoing benefit. In cash flow improvement, we can see whether the company is taking benefit of all the contemporary options available. In process improvement, we can check whether current processes can be automated, streamlined, and have wastage removed. And in risk management, we can ensure that cash does not leak out on an ongoing basis from taxation point of view. Next slide, please. So there are some strategies which company can adopt to restructure the processes and policies in relation to collection, payment, and recovery of VAT. And these strategies can be maximizing input tax recovery, VAT process improvement, invoicing and tax point planning, forming a tax group, liaising with Federal Tax Authority, apply for a tax relief, and expedite the tax refund. So let's discuss all these strategies one by one. Next slide, please. The first strategy for cash optimization can be maximize input tax recovery. To maximize input tax recovery, company can analyze input tax recovery on employee personal expenditure and petty cash expenditure. Because as per Article 53 of VAT Executive Regulation, input tax shall be non-recoverable if goods and services were purchased to be used by employees for no charge to them and for their personal benefit, including entertainment services. But there are some exceptions also. The first exception is where it is a legal obligation to provide. And the second exception is where it is a contractual obligation or a documented policy. So if a company can properly analyze these two exceptions, then recovery amount of input tax credit can be maximized. And FTA has given some clarification also regarding this. As per FTA clarification on input tax deduction, the VAT charged to the employees for any expenses can be recovered by the employer also, but provided that these expenses should be for business only. Let's say example of mobile phone expenses. Input tax is recoverable on the connection charges and the business element of call charges. We can take another example of hotel accommodation. Input tax is recoverable if accommodation is provided to the staff only for the business trips. So in a nutshell, company can review and make changes to the input tax credit recovery policy to maximize the input tax credit, which can have the positive impact on the cash flow of the company. Then another strategy can be to have a better cash flow to consider the relief for bad debts provisions. During this COVID situation, many companies are facing challenges to recover from its debtors, and bad debt rate is high for some of the industries. In this situation, company can at least get the benefit of VAT already paid on supply made in the past. As per Article 64 of the VAT Decree Law, a company may reduce the VAT in a current tax period to adjust the tax paid for any previous tax period. That means if company can fulfill the three conditions for claiming bad debt relief, then they can get at least 5% VAT which they have already paid on the supplies. And these three conditions are, the first condition is consideration for the supply has been written off in full or part. And the second condition is the supply has been made 6 months prior to the date. And the third condition is supplier has notified the recipient the amount of consideration that has been written off. So by claiming bad debt relief, company can get at least 5% VAT, which it has already paid to the FTA on supply made to the debtors, which become bad debts now. Then another strategy can be to review current timing and process of receipt of tax invoice from the supplier. Some companies are doing payment in advance to the supplier, but they are receiving the invoices after a certain period of time, which can negatively impact the cycle of input tax credit. Specifically in construction sector, if we see, where generally payment has to be made in advance, but the companies are receiving invoices after a longer period of time, it can negatively impact the cash flow of a company. So company can review the time gap between payment and the receipt of invoices from the supplier to maintain a positive cash flow. Another strategy for maintaining a positive cash flow or cash flow improvement can be to ensure receipt of correct tax invoices from the supplier. As Article 59 of VAT Executive Regulation says that a company can claim input tax credit only on the basis of proper tax invoices. If today company is receiving any improper tax invoices, then company would not be able to claim the input tax credit on time, which can again negatively impact on the cash flow. So company can redefine their payment policies and give instruction to the respective departments to release the payment to the supplier only upon the receipt of proper tax invoices. It can have adequate positive impact on the VAT recovery of the company and will have positive impact on the overall cash flow of the company. Next slide, please. Next strategy to improve cash flow can be VAT process improvement. Review of accounts payable processes in order to avoid the reversal of input tax credit can be a major idea to look in. As per Federal Tax Authority clarification on input tax deduction, to claim the input tax credit on any invoice, the company must have intention to pay the consideration of any invoice within 6 months of the agreed date of payment. But in case the input tax has recovered, but the consideration is not paid within 6 months, then company has to pay the VAT amount to the FTA. Again, non-payment to the creditors in stipulated time can negatively impact the cash flow. Company should take care. Next slide, please. Another strategy to improve cash flow can be invoicing and tax point planning. Without some companies, without receiving the payment and without making the supply, just raising the invoice in advance for a longer period of time is not a good idea for any company, because it blocks the cash flow of a company. Because as per Article 25 of VAT Decree Law, company has to pay VAT to the government as soon as 3 of the scenarios are occurring in the company. The first scenario is the date on which goods is delivered or the services has been completed. Another scenario is the date on which the payment has been received. And the last is when the company is raising tax invoices. If the company has a long-term contract for the supply of goods and services and also know in advance that the payment will be received after few months of delivery, then company can get the benefit of Article 26, where it is mentioned that the date of supply of any contract that includes periodic payment or consecutive invoices can be 1 year from the date of provision of such goods and services. What it means? This means company can raise invoice within the 1 year of date of supply of goods and services, which again can have a major positive impact on the cash flow of the company. Next slide, please. Another strategy to manage cash flow is to form a tax group of related companies. As per UA VAT law, 2 or more persons or 2 or more companies conducting businesses may apply for a tax group. A tax group is a group of 2 or more persons registered with the FTA as a single taxable person subject to the fulfillment of certain conditions given in the UA VAT law. Here, related parties refers to 2 or more persons who are not separated on the economic, financial or regulatory level, where one can acquire the control by law or through the acquisition of shares or voting rights. So again, forming of any tax group of 2 or more related parties can have a positive impact on the cash flow of the company, because intercompany transaction will not have any VAT impact after forming a tax group as per UA VAT law. Next slide, please. Yes. So another strategy to manage cash flow can be liaising with the Federal Tax Authority. Getting clarification from the Federal Tax Authority in case of any transaction where company has any ambiguity is good idea to refrain the company from penalties in future, which can have a major negative impact on the cash flow of a company in future. So today, any company can go to the FTA and ask for a written clarification where company is not sure about the taxability. Then another strategy can be requesting for exception, such as changing VAT return period from monthly to quarterly. So let's discuss what is VAT administrative exception. A VAT administrative exception is a mechanism which provides companies with concession or exception in difficult circumstances, prevent them following certain procedural aspects of the law. Company can submit VAT administrative exception for various reasons, like for example, if a company is not able to maintain the proper tax invoice as the guidelines given by the federal FTA, then for tax credit notes, then length of the tax period, or evidence to prove exports of goods or time for exports of goods. Let's say example of e-commerce companies. If any e-commerce company in UAE, they are going to send any goods from UAE to Saudi for 100 or 150 dirham, they are not able to get the custom exit certificate. But as per UAE VAT law, every company has to maintain the custom exit certificate. So in this case, these e-commerce companies can go to the FTA for application of these administrative exceptions, so that these companies should get exceptions for maintaining those type of documents. Next slide, please. Another strategy to manage cash flow can be apply for tax relief in challenging times. In order to provide relief for taxpayer, the Federal Tax Authority of UAE has announced a general extension of 1 month for filing VAT return and payment of related tax for VAT and excise both. And these extension was applied for the return for the period of March 31st, 2020. But in future, FTA can come up with more relief for the taxpayers. And time to time, all the companies can check with the FTA whether any relief is whether they are eligible for any relief from the Federal Tax Authority. Next slide, please. Yes. So another strategy to manage cash flow can be to expedite the refund request process. Most of the companies in UAE who are into zero-rated supply or out of scope supply remain into refundable position with the FTA. Refund request can be expedited by keeping records as per the format provided by the tax authority. The tax authority provides only 5 working days for replying to providing any data or information requested by the FTA. But many of the companies are not able to provide these data and information within stipulated time because still many companies are facing challenges. They don't know what is the requirement from the FTA and how to maintain the proper documents. So companies should check the documentation and accounting part to provide all the data and information to FTA within stipulated time to get the VAT refund in the least possible time. It can have a major positive impact on the cash flow of the company. I think that brings the end of my presentation. Thank you for listening. And now if there is any question, I would be happy to answer. Thank you very much.
Thank you for the insight on that, Vipin. There has been a few questions come in. There's a couple relating to tax, which I will read out for the audience now. Our company has applied for a VAT refund at the time of filing the return. However, the VAT refund is still pending after 2 years. Can we again apply for VAT refund 2 years in one time?
Oliver, I'm not getting your question. Could you please repeat one more time?
Yeah, our company has applied for a VAT refund at the time of filing the return. However, the VAT refund is still pending after 2 years. Mm-hmm. Can we apply for a VAT refund of 2 years at one time?
Okay, so I think these are two separate questions. The answer of first question is the VAT refund has been rejected or the company has not replied. If the FTA has already rejected the refund, then we have to apply in a fresh manner, and the company can apply for VAT refund any point of time and company can go quarter on quarter wise, or company can apply for all the VAT refund for last 2 years at one go. Thank you.
Thank you, Vipin. And there's one more question. Is there any timeline for claiming VAT relief on bad debts, and whether we have to show any legal documentation also to the FTA for claiming bad debt relief?
Yeah, I think this question is very relevant nowadays during this situation. Like after COVID, many of the companies are facing challenges, specifically for many of the debtors are becoming, bad nowadays. So company can apply to get 5% VAT back, because when the company has raised the invoice, company maybe had paid 5% VAT to the FTA. So company has to, follow a procedure given by the FTA. Means you can say 3 conditions. The first condition is the company has to write off from the books. And the second condition is the supply should be 6 months old. Like for example, if a company has made a supply 3 or 4 months back, so you cannot apply for a relief from the FTA. And the third condition is the supplier needs to notify to the recipient as well. So for example, today if I need to claim any relief from the FTA, first of all, I need to notify my debtors as well that I am, writing off from my books. So if the company can, fulfill these 3 conditions, any point of time, I can go to the FTA to claim 5% back to my company. There is no time limit for the same. Thank you.
Okay, thank you. We'll just have some more Okay, these are the similar. There's a couple more, Vipin, which have just come through. I'll move on to the risk. I believe these are risk-oriented questions. If you can just have a quick review of the tax questions which have come in. From a risk point of view, Alok, I believe this will fall under your jurisdiction.
Yeah.
How much time does it take to implement a cost optimization framework in a mid-size organization?
Thanks, Oliver. So it's question. Implementation of the framework usually is dependent on the industry vertical as well. So whether you are in a healthcare industry or education industry or a trading manufacturing organization, right? This is something which is which would actually govern how much time it would take. Also the size of your operations, primarily the number of departments, locations, number of business activities which you are undertaking, whether you are a holding company or an operating company. All these things usually would have a major factor, but it can take anywhere between 3 to 8 weeks, depending upon the factors which I just mentioned. However, just to support the businesses, we at MBG help organizations by conducting a high-level quick assessment. This gets completed within 2 days, and it provides an organization with high-level view of the benefits it can achieve through the cost optimization exercise and also the approximate time it will take. This helps the organization to take informed decisions.
Thank you, Alok. And just one more, I believe, on debt restructuring. Can debt restructuring in the current scenario get me additional funding?
Good one. Frequently asked question nowadays. Where can I get additional cash? The answer is yes. Additional funding can also be availed subject to proper presentation of the financial institution. Your relationship with the financial institution is also something which is very important in this case. You need to actually present to the financial institution a complete credit history, the future projections, and revised covenants or the renegotiated terms. As highlighted previously in the webinar also, we have helped clients with facilities totaling more than $1 billion dirhams to restructure, and were also able to get additional cash in almost all the cases. In the current pandemic situation, I'm talking about restructuring exercises which have been completed in March, April, May this year only. Hope that's fine, helps actually. Anything else, Oliver?
Oliver, are you there?
Alok, sorry. There's one more question, my apologies. Do we need to perform a full review of working capital as a whole, or can we review each as a sub-process?
It's always better to see the holistic picture as a whole cycle, because there are several interdependencies. So if we are doing one sub-process in isolation, we may actually miss out some inefficiencies or cash trapped in another sub-process. So always advisable to perform this review comprehensively. But to theoretically answer the question, yes, sub-processes can be reviewed independently as well.
Okay, thank you, Alok. There's some specific tech questions around tax. What we will do to all the audience, there's some questions which we, in the interest of time, we don't have time to address. We will reach out to everyone individually, but also please do let us know. We'll put the contact details at the end of the screen. You can reach out to us directly if there's specific questions on specific topics. What we've put out is more general. But obviously, if there's key things, we want to try and address those with you individually. Okay, ladies and gentlemen, I think from our side, we'll now draw the webinar to a close. Thank you to all the speakers for the informative and insightful session. As a point of note, ladies and gentlemen, we'll be running another webinar very shortly, which will keep you informed of on economic substance regulation, which is a key time-bound requirement for a lot of organisations at the moment. So we will be running a session on that, and we can support organisations with that as well. In the meantime, ladies and gentlemen, thank you for your time. We will continue to run thought leadership sessions to support your organisation. If you have any questions, do reach out to us, as I said. But on behalf of the MBG Corporate Services team, thank you very much. Have a good day and a good weekend.
Thank you.
Thanks.
Thank you.